In the basements of the People's Bank of China, there is a weapon capable of destroying the American economy in 48 hours. Not nuclear warheads, not biological weapons, not an army of 2 million soldiers, paper. More precisely, $800 billion in United States Treasury bonds. While Washington discusses military threats and cyber attacks, Beijing keeps its finger on the trigger of financial Armageddon. One order, and the dollar collapses, interest rates soar to 15%, the stock market loses 40% in one day, and the United States government cannot service its debt. This is not a conspiracy theory. This is mathematics. And today we will examine how China turned American debt into a weapon of mass destruction. The debt trap, how the United States became dependent United States national debt, $36 trillion. This is more than the country's gross domestic product. Every year the government spends $2 trillion more than it collects in taxes. Where does the money come from? From borrowing. The United States issues treasury bonds, debt obligations with a promise to repay the money with interest. The whole world buys them because they are considered the safest asset on the planet. But here's the catch. $8 trillion out of $36 trillion are held by foreign countries. And the second largest holder after Japan is China with $800 billion. Although officially it is $800 billion. The real figure may be twice as large if you count purchases through offshore jurisdictions, Hong Kong, the Cayman Islands, Luxembourg. How did China become America's creditor? This did not start yesterday. For decades, China exported goods to the United States. Electronics, clothing, toys, everything imaginable. Americans paid in dollars. By the end of the 1990s, China had accumulated hundreds of billions of dollars. What to do with this money? Convert it into yuan? That would collapse the yuan exchange rate, make Chinese exports expensive, and kill the economic model. Hold it in cash? It brings no income and inflation eats it away. The solution was elegant. Buy United States Treasury bonds. Reliable, liquid, yielding 3 to 4% per year. Thus, a financial symbiosis emerged. China produces goods, sells them to the United States for dollars. The United States spends dollars and borrows from China by issuing bonds. China buys the bonds and finances American consumption. The circle closes. China was lending to its main customer. Brilliant, but dangerous. Why did bonds become a weapon? The basic logic is simple. If China decides to sell $800 billion in bonds at once, the market will choke. Supply will exceed demand by dozens of times. What happens when supply exceeds demand? The price falls. When bond prices fall, their yield rises. Why? Mathematics. A bond with a face value of $10,000 and an annual payment of $400, meaning a 4% yield, trades at a price of $10,000. If China floods the market, the price falls to $8,000. A new buyer pays $8,000 but receives the same $400 per year. The yield becomes 5%. If the price falls to $6,000, the yield is 6.67%. To $5,000, 8%. And now the key point. The yield on Treasury bonds is the base interest rate for the entire American economy. It determines mortgage rates, corporate loans, credit cards, auto loans, and the cost of servicing the national debt. If bond yields jump from 4% to 8 to 10%, the entire economy collapses. First, the government will not be able to pay its debt. The United States currently pays about $1 trillion per year in interest on a debt of $36 trillion at an average rate of 3 to 4%. If the rate rises to 8%, interest payments become $2.9 trillion per year. This is more than the budgets for defense, healthcare, and Social Security combined. The government will physically be unable to pay. A technical default. Second, mortgages become inaccessible. Mortgage rates are tied to bond yields. They are currently around 7%. If bond yields soar to 10%, mortgages jump to 15 to 20%. At a rate of 20%, almost no one can buy a home. The real estate market freezes. Prices fall by 40 to 60%. Third, corporations go bankrupt. Thousands of companies live on cheap credit. If rates soar to 12 to 15%, they cannot refinance their debts. Mass bankruptcies. Unemployment explodes. Fourth, the dollar collapses. Foreign investors see panic. Everyone starts selling bonds and fleeing the dollar. The dollar exchange rate collapses by 30 to 50% against other currencies. Imports become 50% more expensive. The United States imports 40% of consumer goods. Inflation soars to 20 to 30%. Fifth, the stock market in free fall. High rates kill lending and corporate profits. The S&P 500 can fall by 40 to 60%. Pension funds and 401k accounts are destroyed. All of this without a single soldier, tank, or missile. Why has China not pulled the trigger yet? Because this is a doomsday weapon. Mutual destruction. If China sells $800 billion in bonds, prices collapse. They sell cheaper than they bought. The loss is hundreds of billions of dollars. The United States is China's largest export market, more than $500 billion per year. If the American economy collapses, who will buy Chinese goods? China's foreign exchange reserves are $3.2 trillion, most of it in dollars. If the dollar loses 50% of its value, China loses $1.6 trillion in purchasing power. This is the financial version of the nuclear doctrine of mutually assured destruction. That is why Beijing keeps its finger on the trigger, but does not fire, for now. But there are scenarios where the losses become acceptable. When could China fire? Scenario 1, war over Taiwan. The United States has declared that it will defend Taiwan. China considers the island its territory. If the conflict enters a hot phase, Beijing can use the financial weapon. You defend Taiwan, we collapse your economy. Scenario 2, sanctions like those against Russia. If the United States freezes Chinese assets or disconnects China from SWIFT, as happened to Russia after the invasion of Ukraine, China will respond by selling bonds. Financial mutual destruction. Scenario 3, de-dollarization reaches critical mass. China is building an alternative financial system. The yuan in international trade, CIPS instead of SWIFT, gold instead of dollar reserves. When the system is ready, China can dump the dollar ballast. Scenario 4, an internal crisis in China. The Chinese real estate bubble bursts, banks crack, Beijing sells bonds to obtain liquidity, saving its own economy at the expense of the American one. Signs of preparation are already visible. China is not sitting idle. Preparation is in full swing. Reduction of bond holdings from $1.3 trillion in 2013 to $800 billion in 2024, minus $500 billion in 11 years. China is methodically exiting American debt. Accumulation of gold. Since 2022, China has added more than 400 tons of gold to its reserves. Record purchase rates. Gold does not depend on the dollar and cannot be frozen by sanctions. The yuan in international trade deals with Russia, Saudi Arabia, Brazil, Argentina in yuan, bypassing the dollar. The petro-yuan instead of the petrodollar. The CIPS system, China's alternative to SWIFT. Already operating, volumes are growing. It allows trade without dollars and without American control. Purchases of strategic resources, oil, gas, metals, food. China is stockpiling in case of sanctions or a crisis. This is not a conspiracy theory. This is the official strategy of the People's Republic of China, described in Communist Party documents. The countdown has already begun. Conditionally, the year 2027. The Taiwan crisis. The United States has imposed sanctions. Beijing decides. Announcement to the people. S-Bank of China publishes a statement. In response to the economic aggression of the United States, China begins a reduction of its portfolio of United States Treasury bonds. The first sale is $200 billion. Asian markets. Tokyo, Hong Kong, and Shanghai react instantly. The yield on 10-year bonds rises from 4.2% to 5.1% in the first hour. An increase of almost 1% is an earthquake. Futures. The S&P 500 minus 7%, the Nasdaq minus 10%, the Dow Jones minus 6%. The New York Stock Exchange opens. The New York Stock Exchange opens in chaos. The S&P 500 falls 12% in the first minute. An automatic trading halt. Trading resumes, another minus 7%. A second halt. Bond yields reach 6.8%, an increase of 60% in one day. Emergency meeting of the Federal Reserve. Jerome Powell announces the Federal Reserve immediately begins purchasing bonds. A quantitative easing program of $500 billion. Markets will stabilize. But the markets do not believe it. $500 billion versus $200 billion of Chinese selling plus panic selling is a drop in the ocean. By the close, the S&P 500 minus 18%, the Nasdaq minus 24%, the Dow Jones minus 16%, bond yields 7.2%. $5 trillion of market capitalization evaporated in one day. Panic selling other bondholders see that China is dumping. Herd psychology switches on. Japan begins selling $100 billion. Saudi Arabia and the United Arab Emirates sell $50 to $100 billion. European investors and hedge funds panic. Everyone sells. Bond yields soar to 9%. They have doubled in a week. Impact on daily life mortgages rise from 7% to 13 to 14%. The real estate market freezes. Home sales fall 60%. Auto loans rise to 15 to 18%. Credit cards reach 25 to 30%. Companies go bankrupt. Government in crisis. The Treasury attempts to issue new bonds. The auction fails. The United States is forced to offer 11 to 12% yields. Interest payments at 10% equal $3.6 trillion per year. Tax revenues are $4.5 trillion. $900 billion remains for defense, Medicare, Social Security, and everything else. Mathematically impossible. Economic collapse. Unemployment rises from 4% to 15%. The S&P 500 minus 42%, the Nasdaq minus 50%. $12 trillion of market capitalization evaporated. The dollar minus 25 to 35%. Inflation 12 to 15%. Banks go bankrupt. The Federal Deposit Insurance Corporation is overwhelmed. Silicon Valley Bank in 2023 looks like child's play compared to this. Protests in major cities. Anti-Chinese sentiment. Curfews. The Federal Reserve faces a choice. The Federal Reserve has bought $800 billion of bonds. The money supply has grown 15%. Inflation accelerates to 20%. Three options. Option A, printing leads to hyperinflation of 30 to 40%. Option B, rates of 15 to 20% lead to a Great Depression 2.0, unemployment 25 to 30%. Option C, partial default, 70 cents on the dollar, the end of the dollar as a reserve currency. The Federal Reserve chooses a combination, moderate printing plus rates of 8 to 10% plus austerity measures. The result is stagflation. The new reality, gross domestic product minus 8 to 12%. Unemployment 18 to 22%. Inflation 18 to 25%. The dollar minus 40%. A salary of $60,000 equals purchasing power of $36,000. Pensioners are destroyed. Homes minus 30 to 40%. Gasoline $8 to $10. The middle class disappears. Geopolitics. The United States, defense minus 30%. Bases are closed. Aid to allies is reduced. Ukraine, Israel, and Taiwan lose support. China. The yuan becomes the second reserve currency. BRICS trade in yuan. Dominance in Asia, Africa, and Latin America. The unipolar world has ended. Multipolarity, China, the European Union, Russia, India. NATO is in question. China suffered losses of 3 to 5% of gross domestic product and $200 to $300 billion, but recovers faster thanks to its domestic market and state control. After several years, China is restored, while the United States remains in crisis. The picture is grim, but is there a way to protect yourself? For a country, limited. For you, yes. Can the United States prevent an attack? Option 1, ban China from selling bonds. Technically impossible. Bonds trade on global markets. The United States cannot ban China from selling without destroying the entire system. If the United States tries to freeze Chinese assets, as it did with Russia, it would prove to the world that American assets are unsafe. All countries would begin withdrawing reserves. The effect would be worse than a Chinese attack. Option 2, reduce dependence on foreign buyers. The Federal Reserve and American investors would have to buy more bonds so that China is not critical. The problem is that domestic demand is insufficient. The United States issues trillions of bonds every year. Without foreign buyers, the Federal Reserve would have to print money, which leads to inflation. Option 3, reduce the deficit. If the United States reduced the budget deficit from $2 trillion to zero, dependence on China would decrease. But this is politically impossible. It requires cutting social programs, such as Medicare and Social Security, or raising taxes. No party wants this. Option 4, diversify the debt. The United States could stimulate other buyers, such as the European Union, Japan, and private investors. But Europe and Japan are themselves deeply in debt. They cannot replace China. The reality is that the United States is vulnerable and has almost no protection. What does the United States do in practice? The United States is trying to move production out of China to friendly countries such as Mexico, Vietnam, and India. But this will take 10 to 20 years. It bans the sale of advanced chips to China. It increases its military presence in the Pacific, but financial weapons bypass military deterrence. China can attack the economy without war. The conclusion is that the United States is preparing, but not enough. What should an investor do? You cannot stop China, but you can protect your portfolio. Diversify away from dollar assets. If China attacks, the dollar will depreciate. Do not keep everything in dollars. Alternatives include gold and silver, physical metal. Gold rises when the dollar weakens and geopolitics intensify. Store it at home or in private storage. Foreign currencies such as the Swiss franc, the Singapore dollar, and the Norwegian krone, with accounts in banks in those countries. Non-dollar assets such as European and Asian equities, not Chinese, and real estate outside the United States. Avoid long-term United States bonds. If bond yields jump from 4% to 10%, prices will collapse by 40 to 50%. Holders will lose fortunes. Instead, consider short-term bonds. such as Treasury bills with maturities of 3 to 6 months, which have lower volatility, inflation-protected securities, and corporate bonds of strong companies, but with caution, because in a crisis they also fall. Invest in real assets. Assets that do not depend on the dollar system include real estate, preferably without a mortgage land, and homes commodities, such as oil, gas, and metals exchange, traded funds like DBC, and shares of commodity producers, such as energy companies, mining, and agriculture. Cryptocurrencies with caution. Bitcoin is often called digital gold, a hedge against inflation and a dollar collapse. In a crisis, it can soar. The risks are volatility, it can fall by 50%, and regulatory pressure, because governments may ban crypto in a crisis. If you invest, no more than 5 to 10% of the portfolio. Hold it in your own wallet, not on exchanges. Geographic diversification. Do not keep all assets in the United States. If a Chinese attack collapses the American economy, your dollars, stocks, and real estate will suffer. Diversification locations include Switzerland with bank accounts and gold in vaults, Singapore with a stable economy and banking system, Scandinavia, such as Norway and Sweden, with strong economies and low debt, and New Zealand and Australia with physical remoteness and resources. Watch warning signals. A Chinese attack will not be sudden. There will be signs. Alarm signals include China accelerating bond sales, for example, reducing holdings by more than $100 billion per quarter, escalation of geopolitics, such as conflict around Taiwan and United States, sanctions against China, a sharp rise in bond yields, for example, jumping from 4% to 5.5 or 6% in a month without reason, and a sharp weakening of the dollar, a fall of more than 10% in a month. At the first signs, move money out of long-term United States bonds, buy gold and foreign currencies, transfer part of assets abroad, and keep cash to buy assets at the bottom of the crisis. Prepare for the worst case. If China attacks and the economy collapses, unemployment will surge, inflation will accelerate, and unrest is possible. Preparation includes an emergency fund covering 6 to 12 months of expenses, reserves of food, water, and medicines, useful skills such as repair and food production, and community connections, because in a crisis, groups survive, not loners. Final thought. China holds $800 billion of financial weapons. The laws of geopolitics say that when two superpowers compete for dominance, conflict is inevitable. China is preparing. It is reducing bonds, accumulating gold, and building an alternative financial system. The United States is vulnerable. $36 trillion of debt, dependence on foreign buyers, and political dysfunction. The question is not whether China can, but when it will use the weapon. United States Treasury bonds are not just investments. They are hostages in the hands of Beijing. When China decides that the price is acceptable, it will pull the trigger. The United States economy will collapse. The dollar will depreciate. The world order will change. Protect yourself. Diversify away from dollars and American bonds. Invest in real assets. Watch for signs of an approaching crisis. The financial war has already begun.